Welcome to the Explainer. So today we're zeroing in on a highly focused briefing all about the landmark India-US trade deal. And we're looking at this specifically through the lens of a retail stock investor. Look, if you've been watching the ticker lately, you already know something massive just shifted. Let's dig into exactly how this historic agreement is completely resetting the rules of global trade, and honestly, what it means for your own portfolio. Right out of the gate, let's look at the immediate market reaction. The literal second this interim trade framework was announced, boom, a massive 2.8% spike in the Nifty index. The benchmark indices have been inching toward record highs anyway, driven by this broad equity rally, but the market is clearly pricing in a ton of optimism here. As investors, though, we need to know exactly what's throwing fuel on that fire. And the main catalyst for all this euphoria? It's a dramatic, game-changing drop in U.S. reciprocal tariffs on Indian goods. We're talking about REITs plummeting from a highly punitive 50% all the way down to just 18%. For months, Indian exporters have basically been suffocating under that 50% cumulative burden. And you know how heavily those kinds of fees just eat right into earnings. This sudden cut to 18% instantly revitalizes the margins for Indian manufacturers trying to sell into the world's largest consumer market. To figure out what this means for you, we're going to quickly walk through what actually happened with the deal, why the markets rallied so hard, the big macro supply chain shift, specific sector winners and losers, and finally, the long-term risks you absolutely need to watch. All right, part one, the deal itself. What actually happened here? At its core, this agreement is a giant sigh of relief for Indian exporters. It standardizes the tariff rate at 18% on a massive, massive volume of goods. Literally, over $30 billion worth of Indian goods exports are instantly becoming way more competitive on American shelves. That kind of sweeping reduction provides immediate, tangible relief across a whole bunch of industries. But look, this isn't just a freebie. It's a two-way street. India has signaled this aspirational intent to buy $500 billion in U.S. goods over the next 5 years. Stuff like energy products, tech, aircraft. But here is the catch, and it is a huge one. The U.S. has tied this whole tariff relief package to a very sensitive geopolitical condition. India has to commit to halting its imports of Russian oil. So it's this incredibly complex trade-off of economic access for geopolitical alignment. Moving on to part two, why exactly did Dalal Street respond with a 2.8% rally? Well, while the broader Nifty jumped 2.8%, the Nifty IT index went on an absolute tear, soaring more than 6% intraday. IT services already make up a massive chunk of our exports to the US, so when trade barriers fall and relations stabilize, investor confidence in these heavily export-reliant sectors just skyrockets. The big takeaway here is margin visibility. This deal directly improves the order pipeline stability for any company dependent on American demand. Think about it. When you cut tariffs from 50% to 18%, you dramatically reduce the risk of margin compression. Companies don't have to sacrifice their own profits just to keep their shelf prices competitive anymore. That means better pricing power, which leads to better profit margins. And honestly, the stock market absolutely loves that kind of clarity. Zooming out to the macro level, economic models are actually projecting this deal could add about 0.52 percentage points to India's GDP growth. Now, 0.52% might sound like a tiny sliver, right? But in the context of a multi-trillion-dollar economy, that is a massive structural tailwind. It creates this real ripple effect across the entire economy. Which brings us to part three, the global supply chain shift. Just look at this new reality. At an 18% U.S. tariff rate, India suddenly undercuts key manufacturing rivals. We're beating Vietnam and Bangladesh, who are sitting at 20%. We're beating Pakistan at 19%. And most importantly, we now hold a massive, undeniable advantage over China's 37% tariff rate. We literally went from having some of the highest tariffs to being one of the most highly competitive options in all of Asia. This completely rewires the global supply chain. You've probably heard of the China Plus One strategy, right? Well, as U.S. importers frantically look to diversify away from China, India is no longer just a theoretical alternative. With this new, stable framework, we are positioned to actually capture that manufacturing exodus with highly competitive pricing. Okay, part four, let's talk about the specific sector winners and losers. For your portfolio, you've really got to split the board here. The export winners are glaringly obvious. Textiles, IT, and pharma are getting fantastic U.S. market access. But remember the other side of the deal? India agreed to lower its own barriers too. If our import tariffs on U.S. goods drop to zero, local companies in the auto, electronics, and chemical sectors are going to face some intense, direct competition from American products flooding the domestic market. Let's zoom in on those winners for a second. Labor-intensive industries are getting a massive boost. Textiles and apparel companies now have a major edge over competitors in places like Bangladesh and Cambodia, who are still staring down tariffs of 35% or more. Gems and jewelry are seeing immense relief. Even generic pharmaceuticals could eventually see their reciprocal tariffs drop all the way to zero. But hey, it's not a clean sweep. If you hold heavy metals in your portfolio, definitely pay attention to this. Steel, aluminum, and copper, they got left out in the cold. They have not been granted relief and are still facing those steep 50% duties under U.S. Section 232. Those are designated as national security tariffs. So the benefits here are incredibly sector-specific. Finally, Part 5, the risks investors absolutely must watch. Let's circle back to that massive geopolitical string attached to this deal. Over the last few years, Russia actually displaced Saudi Arabia to become our largest crude supplier. Buying this discounted crude has been saving the Indian economy something like $9 to $10 billion annually. The U.S. conditioned to halt these imports? That is a very severe economic sacrifice. Transitioning away from that cheap oil means our energy costs are absolutely going to climb. Throw in the potential flood of U.S. electronics and agricultural products hitting our domestic markets, and local margins are going to get squeezed tight. Plus, we're currently enjoying pretty low retail inflation, mostly because of a favorable base effect. As energy costs rise and those base effects reverse, we could see inflation spike again, which might literally force the RBI to rethink its recent rate cuts. So while the initial market euphoria is totally justified by the structural advantage we just gained over our regional peers, you have to ask yourself a tough question. Is your portfolio really balanced to handle the long-term geopolitical and competitive shifts this deal brings? Take a hard look at your export-heavy winners and your domestic-focused vulnerabilities. The rules of the game just shifted under our feet, and it's time to adjust your playbook. Thanks for joining us on this explainer, and we'll catch you next time.